Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and today we're getting an update from our friend and colleague, Jordan Roy-Byrne. Jordan is the editor and publisher of The Daily Gold and also author of the book, Gold and Silver, The Greatest Bull Market Has Begun, a once-in-a-lifetime investment opportunity. And I would say that the greatest bull market has begun, as we've talked about in our last few discussions, Jordan. But just a technical update from you, if you put your technical hat on for us for just a moment. When you look at gold, we're up in the 3400s. We did have that pullback over the last couple of weeks and really over the last couple of months, it's just kind of channeled sideways ever since it put in that high at 3509 on the futures back in April. So we've been stuck in this kind of trading range, but we've had a little bit more life lately as the US dollar has rolled back over again. Gold has been well bid. Does it have the oomph? Does it have the juice to get above 3,500 again, or are you looking at it to stay in this channel a little longer? What's the technical outlook on the yellow metal?
I like your phrasing there because I just did my yesterday I did my monthly interview with Vince Lancy, and I asked him the same question because we were talking about it. We were taken aback by gold strength in recent days. So I've been thinking about that the last few days. I don't have a strong answer. I mean, it's clearly in a bullish consolidation, and the way I'm thinking about it, or at least questioning it, is can gold break out here and run through 4,000, or does it need to consolidate for like another month and a half or 2 months in order to do that? So that's something I'm thinking about in my mind. It's not really changing my positioning because I'm a buy and holder. I'm not a short-term trader. So that's something I've been thinking about. I don't have a strong answer either way. I mean, even if it does break out here and go above 3,500, like there's a target, there's a potential measured upside target of 3,800 or 3,900. And who knows, like maybe you get some kind of a breakout and it pops higher, but then it comes back and it kind of settles somewhere in between 3,500 or 3,800. Like I could see something like that happening where the breakout is kind of a muted move and then it's just part of a larger consolidation. So I think that's one scenario. Another scenario is it just continues to consolidate here for a couple more months. The other scenario is it breaks out here and explodes and runs through 4,000, without much selling along the way. So I kind of doubt that scenario. I think it's going to be one or the other two. But like I said, that doesn't change my positioning. It shouldn't really change anybody else's positioning. That's where we are for gold. I can't remember if you asked about silver, but I'll go into silver. I'm more intrigued by the silver chart. I noticed this a couple days ago. I was looking at it and I realized that little pullback in June to like 35, like that was actually a retest of the breakout. So that was a successful retest. And then you have another higher low potentially that came in, I believe, late last week at the 50-day moving average. And of course, silver has been able to rally after that. So I'm more intrigued by the technicals in silver, where you had this clear breakout. It did stop right at 40 or slightly below. You do have a measured upside target of about 41, so we haven't hit that yet. But as I said, at the end of June or the last week or two, you have a really nice clear retest. And then after the retest, you had a strong move up to nearly 40, a bit of a pullback, about 10% down to 36. Now we're rebounding. So I think with respect to silver, you have to lean on the bullish side here that it's potentially going to get up to that $41 level. Stepping back, looking at monthly, weekly, daily charts, 42 is really significant resistance for silver. That's the biggest resistance along the way to 50. So who knows? Maybe we could see silver at 42 and gold makes a breakout, but it doesn't have a lot of juice and then at call it 3,800 or 42 silver. Maybe at that point you could see some kind of another pullback for several months. So that's how I'm looking at things for the metals right now. Clearly short-term bullish, but the medium term for me is a little murky right now. I'm not quite sure how I see that yet.
Well, let's dial in a little bit even further to silver. Yeah, I definitely wanted to get into it with you because we're at 37.90 above that as we record this, so right below 38. Now, when it made that move up into the 39s and almost got to 40 and then went back down to retest the breakout at 35, as you mentioned, could that have been enough to get through this coming 41 to 42 resistance on the next move higher? Or do you still think that there's enough resistance at that 41, 42 level to keep a lid on silver? And are you using the lateral price resistance from that move in 2011 when silver got up to 41, 42? Maybe speak about why that's a resistance zone in the first place.
Yeah, if you look at the monthly chart, for example, the resistance clearly comes in at 42 if you're looking at the bodies of the two candlesticks that I'm looking at. But there's clearly, you can see looking at the bodies of those two monthly candles back to back, that comes in right below 42. And then if you pull up a weekly chart, or even a daily chart. Like I think on the daily chart it might be between 42 and 43. But you look at all these charts and they're telling you that's the next significant level. You know, breaking above 35, that was a very significant level. 37 as well. That's significant. But and this is one important thing with technical analysis. You have to look at multiple time frames. Like if you really want to solidify your analysis, or at least what conclusion you're drawing from whatever you're looking at, look at daily, weekly, and monthly charts, and even quarterly charts in some sense. Because when they're all lining up and telling you something, that is far more consequential than if you're just seeing something on the daily chart and then it looks totally different on the weekly or the monthly. So a little inside baseball for the listeners there. But yeah, circling back, yeah, I think that's clearly the next level for silver. I don't think silver is going to be able to run up to 50 without a major pullback here and now. Now, that may change in a month or two, depending on how both gold and silver are setting up. But from here and now, I would presume that you're going to see some kind of a pullback at 41, 42. But if I'm wrong and silver runs up to 50, you'd probably see a larger pullback. Like if it ran from here to 50 without much of a pullback, at that point, you might see a more significant pullback. But generally, how I'm looking at it is silver should run up. It'll stop at 41, 42, that area. It'll pull back. Then it'll trend higher to 50. And then at 50, it could pull back again to that 41, 42 area and consolidate bullishly for a while. You know, we're looking at some point early next year. Then after that consolidation, then it's able to break 50. But again, these kind of predictions or at least guesses of where the market could go, these are very fluid. Like I could talk to you a week or a month from now and they could be quite different.
Yeah, I just appreciate you putting a little more color on the thought process there. And of course, everything's a moving target. And if we just see silver blast past 41, 42 and go up to 43, 44, we'll have to relook at it. But there's really not a lot of resistance between 42 and 50. So if it makes the run straight up to 50 without any resistance, like you say, maybe the pullback's a little more severe after that. There's probably a lot of people waiting to ring the register near 50 just because it marks that all-time high from 1980 and 2011. So what we've talked about in the past, if we shift over to the stocks, is that the silver stocks are going to start discounting that move well in advance. I don't know if you feel that the silver stocks already started doing that when we saw that action in June and July, where they were already looking at $50 bullseye, or if you think it's going to take the move to 42, the pullback, and then the stocks discounting it. But in any sense, the markets are forward looking. So how are you looking at silver equities now and what they just did? Have they started pricing in 50 or are they still reasonably priced?
You know, I'd have to reevaluate because I would answer that if you asked me over the weekend, several days, a couple days ago, they were reasonably priced because I was surprised looking at these stocks. Of course, they've had really good moves, but then they corrected a decent amount. Like my top 10 junior analog silver index, which is not necessarily my 10 favorite or I think the 10 best or the 10 that I would own. That index corrected from, I think, 437 down to 360 really quickly. So I don't know if that's 15 or 16% or so. But you get a quick correction like that, that really makes a significant difference. Of course, I'm looking and the silver stocks have rebounded in the last couple of days, although not as strong as the senior gold stocks. But I generally like how they're set up, given that, they've had this correction for a little while. They're off the highs. That's encouraging to me because lower prices and the market not being overheated, that's better for most participants. That's better for newcomers that they can buy high quality companies off their highs and at reasonable prices. That's better than if this thing was just going straight up like a rhino horn, like we like to say. But stepping back, yeah, I do think a couple months ago that the silver stocks were really starting to discount 35, 37, $40 silver. Like they were really at least the juniors on my screen, like the 12 or 15 that I look at, like they were really running nicely and showing a lot of strength. And so at some point, I think that'll happen again. I don't know exactly what the timing will be, but at least to this point so far, the evidence that I've seen leads me to believe that you will see silver stocks discount silver breaking 50. There's going to be periods when, they're really outperforming silver, or like in the last couple weeks, they're underperforming silver because they had such a strong run. So that's how I see it. And again, this is based on the 15 or 17 silver stocks that I'm looking at on my screen, mostly juniors. So if you're only looking at one or two various, 10 or 15 cent juniors and you're saying, oh, well, my stocks are not outperforming, like, you're not looking at the same thing.
Yeah, it's a good point. If you look at a lot of the producers, they did run up in a big way. And a lot of people also, just like the gold stocks, are realizing that, hey, every time that silver adds another buck onto it, that's helping their margins out in a disproportionate way on a percentage basis. So, it may not seem like a lot for silver to go from 30 to 33 or from 33 to 37, but that makes a huge difference for a producer, even though a lot of them only have a portion of silver to their credits because they have a lot of base metals in there or maybe gold. It's still very germane to their bottom line if silver keeps climbing. So I think people were pricing in that higher move, and then some of the better developers and some of the better advanced explorers also getting a nice bid. But then, like you say, pretty big correction the last couple of weeks. So hopefully we'll see the silver stocks get a new wave in them if silver breaks higher and starts testing that 41, 42 level. Shifting over to the gold stocks, though, Jordan, you made a good point in a recent missive to your subscribers that even though there's a lot of attention on the senior gold producers, and we just saw earnings from Newmont and Agnico and Kinross, and they were blowout numbers. And so the seniors getting a lot of love, and rightly so. They've got fat margins, they're making a lot of money over the propensity of time in a bull market, you'll still do better with juniors. And you put out some good analogs on GDX versus GDXJ and just looking at junior returns versus senior. So while the seniors have been in the spotlight, I think it's a good point to remind listeners that the juniors will eventually play catch up. And what are your thoughts there as far as the seniors versus the juniors in the gold equities?
Well, it's good to see the seniors breaking out and showing a lot of strength because that's good news for our sector, the juniors. But there's just quite a few reasons why juniors are better than seniors, provided, as Rick Rule likes to say, you do the work. I mean, if you have to do the work. And again, with respect to specific stocks, if you own a bunch of random Explorer codes that are 15 or 20 cents and you don't really know what you own or understand what they're worth, that this doesn't mean that those companies are going to outperform seniors. Like you have to pick the right junior companies and have a good strong basket. It can't be too big. But if we're looking at GDX versus GDXJ, if you look at various cyclical periods, like if you look at '04 to '07, or if you look at '08 to 11, for example, GDXJ outperformed GDX on the upside. Well, then you might say, okay, well, that's great, but then you're going to underperform on the downside. Yes, that's true. GDXJ underperforms on the downside, the HUI or GDX. But here's the kicker. You get killed in both. Like people remember these cyclical bear markets. Yeah, you might, if GDXJ goes down and loses 80%, the senior indices lose 70%. Like they don't lose 40 or 50%. So you don't really gain anything in a cyclical bear market. Like you really can't hold. You have to be out of both. So if you look at the numbers, they're still fairly close on the downside, whereas on the upside, GDXJ outperforms GDX over 2 to 3 year cyclical periods. And perhaps you can pick your own basket of 10 or 15 stocks that can perform better than GDXJ. So that's where the real opportunity is. And also on a fundamental level, I mean, I could get into some of these other reasons, but like fundamentally, you have the power to understand these junior stocks, whereas senior stocks, senior miner, they have so many different mines. There's so many moving parts. It's really hard for one person to understand what's going on and really understand and learn, become an expert on all the various projects that these senior companies have. So that's really difficult. There's lots of analyst coverage versus if you're looking at juniors, and even if it's a medium-sized junior, there might only be a couple analysts covering the company, and you still might be able to call the CEO and build a relationship there. And that can really help your understanding of the company and your research. So you have the ability to become an expert on these various junior companies. So there's that. There's also a liquidity advantage. These big funds that get into these juniors, they're married to them. Like they can't trim, they can't take profits. They have to be married to them. That's why, Eric Sprott, for example, has so many turds in his portfolio because he can't, if he doesn't like something, he can't, oh, I'm going to trim my gigantic position. He can't do that. He has to ride it up, till it gets acquired, or he rides it down till it's down 90%, and then he decides to sell. So that's an advantage you have over big funds like that. And on top of that, we have real potential to go into a mania this time. Like this will be different from the mid 2000s or 2010, 2011, because if you look back and you look at what happened in various sectors in the 60s and 70s, like in the 60s, you had some mini manias in junior silver stocks, junior uranium stocks. Rick Rule talked about this on a couple interviews I did with him. I also mentioned this in my book. And if you go back and you look what happened, silver, I think in 1967, 1968, it did break out and it was trading at a new all-time high. So that was the first time that happened in a while. We know that the large gold stocks then were just performing fabulously. And then we know what happened in the 70s where you had these two epic cyclical bull markets. And at that point in time, gold and silver they had broken out to new all-time highs. So that's really a biggie. They had broken out to new all-time highs. Now, once silver eventually breaks 50 in the next year or 2 or 3 years or whatever, you're going to have both gold and silver having broken out to new all-time highs. And because when a market does that and it runs, that can really catalyze bubble-like conditions or a mania later on. So that can get people really interested. And like the 70s, people can still make money in stocks right now in the stock market. It's still in a secular bull. But eventually, when that fails or when that turns at some point in the next, be it couple years or couple months, then you're only going to have hard assets in a secular bull. You're going to have stocks and bonds in a secular bear. So you have all these things that in the coming years could lead to a real bubble or a real mania in gold and silver in these junior companies. So that's another big reason why I personally favor juniors over seniors. And just to wrap it up, if you want to do the work and become an expert, or at least subscribe to, I'm scratching my own back here, but subscribe to some newsletters where you think the person running it has expertise and can help you, that can help you a lot. Build a great portfolio of junior companies and manage it appropriately. Then you can be in position to really ride this bull market and, potentially make life-changing returns. And so for me, that's why I favor the juniors over the seniors. But you got to do the work. If you don't want to do the work, then all this stuff then doesn't apply to you.
Yeah, such a great point because you can't just buy a haphazard basket of, like you say, junior Explorcos and not really know why you own them. You need to do the intense due diligence, call the companies, analyze the sector, do peer comparisons, look at the valuations for the ounces in the ground. And some people don't want to do that. So that's where you would want to subscribe to somebody like Jordan and the Daily Gold or other quality newsletter writers that we have on the show that have done that due diligence for you. If you're a part-time investor and you get the vision, take somebody else's advice and let them do the due diligence for you. But if you do your own work, it can be very rewarding. And I think what you said, Jordan, was so important that when you look at a company like Newmont or Barrick or Agnico, man, they got tons of analysts following it. You're not going to figure out an edge that those analysts haven't already dove into, 20, 30 times already. But when you look at some of the junior, even some of the mid-tier producers and small producers in gold and silver, and then obviously down into the developers and advanced explorers, some of them have very few people at all covering them. Maybe they have a few institutions in there, but they're not institutions that are widely read. So as a retail investor, you can really have an edge. And if we get to that mania phase, really experience outsized returns that the big boys don't get. One area that we both agree on, and we have a lot of overlap here, Jordan, is your holy grail type of companies, which are growth-oriented gold producers. So they're a producer, but they've got growth on tap and value creation either through expanding production or through exploration. And so it's not just that they're a producer in a gold bull market, but they're a growth-oriented gold producer. Maybe to speak to why you think that's such a powerful place for people to be if they're building their own portfolios.
Well, developers and growth-oriented producers that are able to invest in exploration at the same time can really really outperform if they have successful exploration compared to, and I'm not saying, you shouldn't avoid exploration companies completely, but a lot of these smaller companies, they have to dilute, raise capital every year, and they're living and dying on drill holes, basically. And again, so the dilution, if they're not making success with every raise, they're falling farther and farther behind. Whereas if you look at a junior producer or a junior developer that maybe has lots of cash, if they're still investing in exploration, they're trying to add value to their project. I don't want to say it's free almost, but if they don't find anything, it's fine because they're still cash flowing or they're still building the mine that they have already. So I like that kind of comparison. And also these companies, they don't need to find like 3 million or 5 million ounces for something to be really significant. Like some of these companies, they've just found a high grade 300,000 ounces or 500,000 ounces. That can completely transform the project. I don't want to name names, but there's two or three already that I own that are popping into my head where, and again, this isn't necessarily like front page news. I mean, it can, apply to gold companies, but also silver companies. If they don't need to discover, they don't need to make massive discoveries to add significant value to what they already have. If a company has a big low grade thing, or let's just say it's moderate grade, but then they just find a little bit of high grade that they can mine first, that completely transforms the margins and the economics of the project. And again, I mean, there's some that I'm thinking about in my head, which I know that you've interviewed that have done that, and that's really transformed the potential and the value of those companies. So that's what I like to look for. I mean, I tell people, I lean towards producers and developers, production growth, building mines. That's where you get the biggest re-rating. It's also that's more predictable than when you're looking at an exploration company. You don't know if they're going to find anything or if they're done or if they're going to make some gigantic discovery. I mean, it's a crapshoot in many cases. So if you're looking at companies that are building mines, that are growing production, you can assess, okay, what is this company worth now? What is it worth in 2 years in the current margins? What'll be worth if margins go up 25%? But as we're talking about here, don't stop there. You want to look for those companies, but at the same time, find the ones that are continuing to invest in exploration and have exploration potential because that can turbocharge the potential of these types of companies.
Yeah, I think that's such a great point, and maybe we'll wrap it up there. Just let people digest that, go look for some of the companies in their own portfolio that maybe don't meet that, and filter them out for ones that do meet that criteria. And if you don't have companies like that in your portfolio, consider subscribing to the Daily Gold, and then you can find out the exact stocks that Jordan has in his portfolio that are on his mind that he has done a lot of due diligence into, called the companies, done a lot of research, and filtered it down to what he thinks is a good portfolio of stocks. So definitely appreciate having you on the show, as always, Jordan. And for people that want to follow along with the Daily Gold, click on the link down in the show notes. It takes you over. At least subscribe and become a free subscriber to Jordan's work. He puts out a missive every week. And if you want to get the goods and find out what he's got in his portfolio, become a subscriber. Jordan, thanks so much for being on the KE Report. And as always, looking forward to our next conversation.
My pleasure. Thank you so much for having me.